Hi there, welcome to Kneppy Invest. One of the great things about doing research on a company, uh, even if it's just for a video like this, is sometimes you can completely change your opinion. And that has exactly happened to me with Domino's Pizzas, as I thought, I'll have a look at their financial year 22 results. And as I delve deeply into their results, and more particular, their potential for growth in the next 5 to 10 years, my opinion on this company has change for the better. So in today's video, even though it was motivated by the financial year 22 results, I'm also going to talk about why my opinion on this company has changed for the better. Now, in terms of quality, I'm just going to put a little bit of a spin on this. In terms of Domino's pizzas, I would define the pizzas that this company produces as low quality. There are definitely better quality pizzas out there, but the old saying is you pay for the quality of what you get. And even though I don't usually very often eat Domino's pizzas, whenever I've bought Domino's pizzas, the price I've paid hasn't been that high. And those pizzas I do like tend to be a much higher price than Domino's pizzas. But again, we are all different. Some people may absolutely love the pizzas that Domino's create, but the pizzas are just not for me. So even though I would rate Domino's pizzas as low quality, the business itself, in my opinion, is a high quality company. So when I said my opinion on this company has changed, it wasn't in terms of the quality of the company. I've always thought this company was of a high quality state. And the reason I think this company is a high quality company is because of the growth this company has experienced over the past 10 years. And not only the growth, the continual growth of selling low quality pizzas. They are doing everything right in terms of marketing, in terms of technologies they are using, and also the expansion overseas has been quite impressive. Now, when I say my opinion of this company has changed, it's all around the value. So for a high quality company, I'm always looking at the value instead of, say, the share price trend. And I thought this company was overvalued until I did a little bit of more research. And now I think there might be some value in Domino's pizzas at these prices. That is what has changed in terms of my thoughts of Domino's pizzas. For full disclosure purposes, I am not a shareholder of this company, but that could change over the next few weeks or next few months, particularly if we see the share price drop from here. So as I'm recording this video, the share price for Domino's Pizza is around about $65. It was as low as about $50 to $55 a few months ago. And if I did this research a few months ago and I saw the share price between $50 and $55, I probably would be a shareholder of this company right now, because at $50 and $55, there is some value at those prices. So if I see the share price fall towards those values, I probably would become a shareholder of this company. Now, if we don't see that drop over the next few months, if we see the share price stabilize, go sideways, or even move into an uptrend, I might take a position in Domino's Pizza at that point. But I can be patient because the share price of this company is still in a downtrend. And we'll have a look at the chart, the short-term chart, so the daily chart, later in the video. Before we have a look at that short-term chart, let's have a look at the long-term chart, a 10-year weekly chart for Domino's Pizza. And it has been a pretty impressive story over the 10-year period. Share price increasing from, we'll say, about $5 or $7 all the way to a high of $165. So I just wish I was a shareholder over the past 10 years. But there has been times, and fairly long periods of time, when the share price have moved into a downtrend. We saw that between 2016 and 2020, when the share price dropped from about $80 all the way down to about $35. So share price more than halved during that 4-year period. And then it rallied, particularly during or just after COVID-19. And of course, one of the reasons why the share price of this company rallied was because of all those people buying pizza from Domino's Pizza because they were locked down. They couldn't go outside and they just decided to buy a lot of pizzas during that period. Share price went all the way to that high of $165. But the share price has fallen from $165 to a current share price of around $65. So the share price has more than halved over the past, we'll say past year and a half. So that share price high was reached in, would have been October 2020 surely, because in October 2020, that's when we got the first signs of a vaccine, and most COVID-19 beneficiaries saw that high at that point in time. So the share price of this company has been in downtrend over the past 2 years. But current share prices, say above $50, and yeah, the share price did reach $50 a few weeks ago, actually a few months ago. It does look really intriguing at these prices. So back in 2016, the share price actually was more than it is right now. So, and the company is much stronger now than it was back in 2016, in my opinion. So definitely more value right now than 6 years ago. So that's another reason why Domino's Pizza is really intriguing at these current share prices. Now to the financial year 22 results for Domino's Pizza. At a share price of $64.62, the markup of this company is $5.6 billion. Now, I set up this video a few days before I actually recorded the video. The share price now is above $65. So it should be obvious as the share price fluctuates higher or lower than $64.62. That will have an effect on the markup. But at a share price of $64.62, the markup is $5.6 billion. And the markup is the most important thing. So you can't look at a share price and determine the value of a company. You have to look at the markup, because the shares on issue for every company is going to be significantly different. The reason I'm saying that is a lot of investors, particularly new investors, have no idea that it's the markup you look at in terms of valuation, not the share price. Some people actually think if a company has a share price of $200, it must be expensive. I've actually heard that quite a few times. And if a share price of a company is 1 cent, it must be really, really cheap. No, it's the markup of the company that determines the value of the company, not the share price. Okay, rant ended. Now, the financial year 22 revenue for Domino's Pizza, $2.3 billion, and really impressive growth over the past 10 years. In fact, we'll have a look at the revenue growth in the next slide. Profit, $159 million. Operating cash flow, $130 million. Now, when I calculate operating cash flow, I take into account leases. So this company would have a fair few leases, and that would mean my calculated operating cash flow would be a little bit lower and a little bit different than the company's operating cash flow that they report. And the free cash flow, when you take into account leases and capital expenditure, was only $10 million. Now, I'm not going to touch upon why free cash flow was only $10 million in this video. So maybe if you are concerned about that, have a look at their financial statements and try to understand why the free cash flow for Domino's Pizza was quite low for financial year 22. So let's have a look at the very impressive revenue growth for Domino's Pizza. So revenue has grown from $261 million in financial year 12 to $2.3 billion in financial year 22. Now, just the revenue growth is impressive, but I prefer to look at revenue per share growth, because some companies make a lot of acquisitions, and to make acquisitions, you do capital raisings, increasing the shares on issue. So revenue per share is what I like to look at. And the revenue per share growth has been very impressive for Domino's Pizza. In fact, over the past 10 years, revenue per share has grown at 25% per year. That's very impressive. Over the last 5 years, it's pulled back a little bit, growing at 20.1% per year. And over the last 3 years, it's grown at 16.4%. The other thing I've included in this particular graph or table, whatever you want to call it, is the gross margins. I don't want to see gross margins falling through time. However, in saying that, we have seen gross margins drop over the last few years from 36% to 31.7%. It's not a concern right now because we have seen significantly lower margins in the past. 2014, we saw gross margins less than 30%. So at this point in time, the drop in gross margins over the past few years has not been a concern, and it wouldn't be surprised to see gross margins rising over the next few years. So over the next few slides, we're going to talk about, or I'm going to talk about, why my opinion of this company has changed. And it's changed around valuation. So I thought maybe this company was overvalued in terms of the share price, or where the share price is right now, or the markup is right now. But because of some things I read in the financial year 22 results and the presentation, I think there's going to be, or could be, some really significant growth for this company over the next 5 to 10 years. That's why my opinion of this company has changed, is just that potential for growth. And if the company does realize that growth I think right now there might be some value for this company. So in this particular slide, we're looking at the network store count over the past 6 years. And this is really important when you look at the next 5 to 10 years, how this company has grown in the past. So the stores have grown from 2,135 in financial year 17 to 3,387 in financial year 22. And the really important thing here is the way this company grows their stores is through acquisitions and organically. And they did provide the organic growth in stores in that red, and it hovers between about 6.5% and 10% new stores per year. So that's fairly impressive organic store growth on a per year basis. They added 450 stores in financial year 22, 898 stores on a 3-year basis. In Asia, 148 new stores plus 156 acquired in Taiwan. In Europe, 123 new stores. In Australia and New Zealand, 23 new stores, but noting 30 plus 30 corporate stores were franchised in financial year 22. So one of the impressive things about this company is that growth internationally, particularly in Asia. But I think also this company has potential for significant growth in Europe. Now let's have a look at the impact of organic new stores on revenue over the past 6 years. And what I've done in this particular slide is separated the revenue into 2 different areas: existing stores and acquisitions and new stores. So we can actually see the impact of organic new stores on revenue. So this is all the new stores, organic new stores they have created in the past 6 years. And all those organic new stores have provided $1.1 billion of revenue in the past 6 years, compared to $2.8 billion of revenue for existing stores and acquisitions. In fact, new stores are 27.6% of all sales. So those new stores, organic new stores, are those they have created over the past 6 years. So we can see the impact of creating new stores has on the revenue of this company. It's fairly significant impact when we look at the last 6 years. In this particular slide, Appendix 2, network store count, found on page 72 of their presentation, they have separated the store count into different geographic regions: Europe, Australia, New Zealand, and Asia. They've looked at the past 3 years and broken down the net stores added in each period. They've actually got full year periods and also half year periods. So the main thing I focused on here is the net stores added in period. And when you look at Australia and New Zealand, they're not adding many more new stores in this region. 6 in financial year 19, 8 in financial year 20, 30 in financial year 21, and 20 in financial year 22. So not much new growth in Australia and New Zealand when you look at the last 3 years. Compare that to Europe: 43 in financial year 19, 64 in 2020, 125 in 2021, and 115 in 2022. And then look at Asia: 80 in financial year 19, 74 in 2020, 126 in 2021, and then 303 in 2022. However, a lot of those stores were because of that acquisition relating to Taiwan. But still, if you take away that acquisition, 148 new stores in Asia, 123 new stores in Europe. There are some store closures there, but overall 438 new stores in the company. Now we get to a slide I became a little bit excited about. This was Appendix 11, so found towards the end of their presentation. And I would say not many people would look at the appendices in the presentation. This was the group Future Outlook, Milestones and Targets. This is a really important slide because I am looking for potential growth in the business over the next 5 to 10 years. And they've provided a next 10-year potential growth in this company. So right now they have 3,387 stores, and they're anticipating, hoping that their store count is going to more than double within the next 5 years, not only in Asia, but also in Europe and Australia and New Zealand. And by far, well, not by far, but they expect Asia and Europe to be fairly close in terms of stores. 3,000 stores in Asia, 3,050 stores in Europe, and only about 1,200 stores in Australia and New Zealand. And also the commentary here, management foresees significant upside beyond 2033 in our existing businesses, particularly Europe and Asia, and is resourcing this through investment in our internal development teams, facilitating franchisee expansion. So even though this is more of a hope and a vision of the company, I expect, not absolutely expect, but I expect this company to approach these expectations they have put forth to us. And of course, if they reach those expectations, even go close to reaching those expectations, I think this company is looking possibly cheap at these prices. Now, in saying that, one of the reasons why I thought this company was potentially overvalued is based off these valuation metrics. P ratio 35.2. That seems fairly high for this type of company. Price to sales ratio 2.4. So that seems fairly high as well. Price to operating cash flow, even higher, 43.1. Also did a reverse DCF. And this company would have to grow at 20.2% per year to justify the current valuation. But in saying that, I think this company can hit that target of 20.2% growth. And not only that, I think this company can exceed that sort of growth rate, particularly if they hit their projections over the next 10 years in terms of store count. Now, another reason I think this company might not be overvalued is if we have a look at Domino's Pizza P ratio over the past 10 years. And this is a really good way just to look at the current valuation of a company and to figure out if it's expensive or cheap based off the past. So right now with a P ratio of around about 35, it's not historically out of the norm for this company. In fact, there have been periods of time and fairly long periods of time when the P ratio of Domino's Pizza is significantly higher than 35. And in fact, whenever the P ratio of this company over the past 9 years has fallen below 30, that is the time to take a position in this company. It happened in 2019 a few times. It happened for a brief period of time during the COVID-19 financial panic, and it has happened a few times over the past few months. So again, just based off this P ratio historical look at Domino's Pizza, this company's valuation is not too stretched at a P ratio of 35. Company did release an October trading update at the AGM, and most companies, when they do have an AGM, should be releasing some sort of trading update because we are a third of the way through the financial year. Third of the way through, aren't we? Yeah. August or July, August, September, October. Yeah, a third of the way of the financial year. And the management of companies should know how the company is performing compared to expectations, or maybe that company hasn't released any expectations. But Domino's Pizza did provide an October trading update. I'll probably call this trading update neutral to bullish, definitely not bearish. And they've broken down the commentary into the three geographic regions: Asia, Australia, New Zealand, and Europe. In Asia, Japan sales have significantly improved since first quarter, which was negative as expected. They mention here a 6% service fee has been added for online orders for carryout and delivery. I wonder why they have done that. That's really interesting. Have to delve a little bit deeper into the reasons behind that. Australia and New Zealand delivering same store sales within the 3 to 6% outlook year to date. So things are moving in the right direction in Australia and New Zealand, or as expected in Australia and New Zealand. In Europe, positive same-store sales growth in October with all markets contributing. I would have preferred they have left a number. So positive same-store sales growth could be 0.1% or it could be 10%. Although if it was 10%, they probably would have mentioned that number. Significant initiatives implemented to offset extraordinary inflation. These include taking additional price across all markets, including a delivery fee on aggregator sales in Germany. Now let's have a look at the daily chart for Domino's Pizza. This goes back to August 2021. Did I say in that weekly chart at the start of this video, the share price high for this company was in October 2020? Because that's completely wrong. The share price high for this company was in September 2021. So I was 1 year out. And in fact, that makes the share price drop even more impressive because the share price has dropped from the high of $165 in September last year to a low of $52 or $51 in October of this year. And in fact, the catalyst behind the shift in sentiment for this company, and that shift in sentiment was from positive to negative, was in November last year. More than likely, that was in relation to the AGM. You can see a massive one-day drop in the share price. You don't see those sort of one-day drops unless there was some sort of negative news from that company, and that was the catalyst for the re-rating the share price. In fact, just after that significant drop in the share price, you can see the share price rallied. In fact, it rallied from $116 to about $132. So some investors saw that significant drop in share price and thought there's pretty good value here. And the reason I thought there was pretty good value wasn't because of any valuation metrics. It was because of the share price. They remember the share price was $165 a few months previous to that share price drop. And they thought, wow, the share price is now $115, $120. That's significantly lower. That's 25% lower than a few months ago. This company is cheap. This company is cheap. That's why the share price rallied. But you can see the share price rallied to the moving averages, didn't quite get above the lows we saw just prior to that drop in share price. So there was a few things going or against the share price moving higher at that point in time. That was a great time to sell if you did hold these shares, because then the share price moved into a well-defined downtrend. You can see between December and we'll say June, July of this year, that's a well-defined downtrend. Nice gaps between the moving averages. They're all spread apart. That's the very definition of a well-defined downtrend or an uptrend if the share price is going up. But we did see a period of time when it looked like maybe the share price wanted to consolidate between about July and August of this year. But then the share price fell down to a low of $51, $50. But we have seen the share price stabilize. And we started to see the moving averages starting to converge. The gap between all four moving averages is starting to become lower and lower. Not only that, the share price has moved above all four moving averages. That's the first time that has happened since September last year. So there is positive signs moving forward for this company. Share price has gone above the previous highs we saw at the start of November, the end of October. So a new high for this company. So things are starting to shift around for Domino's Pizza. Sentiment is starting to shift more positive. The share price is not in an uptrend right now. Can't confirm that uptrend just yet. I'd like to see a new lower high or lower low, So that means the share price would have to drop to say about 50, we'll say $55, $56 or something like that. And if I see the share price drop to say $55, $56, I might take a position. So I need to see that higher low, need to see another higher high, need to see a bit of a change in the moving averages. I like to see the longer term moving average being the moving average on the bottom. So that means we need to see a bit of a crossover between the moving averages. We quite haven't got to that position just yet where I can confirm all those things happening. I expect to continue doing these financial year 22 results video for a while yet. And the next 5 companies I'll be focusing on include Hansen Technologies, Laser Bond, which is a small cap company, Wesfarmers, Phoenix, which is a recommendation, not a recommendation, it's a request, and Fortescue. If you do have any suggestions, preferably profitable companies, it can be a small cap company, large cap company, I don't mind, but preferably profitable. I don't want to be talking about story stocks or concept stocks because the majority of concept stocks have no revenue. And the whole point of looking at financial year results is revenue. Want to see revenue increasing. So please leave any concept stocks, story stocks out of suggestion areas. And if you do have a suggestion, my mouth is getting really dry right now. If you do have a suggestion, just leave in the comment section of this video. That's all I have for this video, looking at Domino's Pizza financial year 22 results, also looking at their potential for significant future growth. That's the main reason why my opinion on this company has changed for the better. Why I don't necessarily think the valuation of this company is too stretched at a P ratio of 35. I think there might be some value there, particularly if this company can reach their goals, their 10-year goals. And if they can reach their 10-year goals, I think a market cap of just above $5 billion might be cheap for this company. So if you completely disagree with me on anything I've said in this video, please leave your thoughts in the comment section of this video, because the way we grow as investors is take aboard different opinions, to look at different opinions, to listen to different opinions. Even if we don't agree with those opinions, I think we can learn, become better investors if we do that. Just don't have our blinkers on, keep in tune with our biases, because biases are an ugly thing. They keep us from growing, not only as investors, but also as human beings. So if you do have different opinions in mind, just leave those opinions in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.